All right, thank you for joining me today for this little talk on should I hold my RSUs now that my stock has fallen. Now, what we're talking about here, of course, is our finances. And our finances should never be, we should never try to optimize every single decision. What we're trying to optimize for is getting to do the things that we want to do in life. That's what money's for. So we don't want to grow money just for the sake of growing money. We want to grow money because we have a need for it and we have a use for it. One way to think about this is this door number one, door number two analogy. Door number one is one direction that you can go in your life where you are able to afford everything that you want to do in life. Door number two is you're going to miss out on things. Now, with financial planning, you're not guaranteed to go into door number one, but you're much more likely to get there if you make decisions today in the context of the things you want to do long term. And the way I look at financial planning is here. So there's four different areas. Protect what you have, know where it goes, that's spending, make it grow, that's investments, that's where we're focused today, and retaining independence and dignity throughout our life, meaning we're not going to live off of our kids in our older age. And we approach all four of these areas with intention and purposeful effort. And our goal is to build your best financial life, not the best financial life on your block, not the best financial life among your friends and neighbors or your Instagram followers or the people you follow, but your best financial life, what you want to optimize for in your life. My process is here on this page, and I only wanted to show this because you see how far down the page investments are. Yes, investments are an important part of financial planning and getting what you want out of your financial life. No, they're not the end all be all. They're the sexiest part. They're the part everybody wants to talk about, but everything else is super important as well. Spending, think about the amount of money that you spend, your lifestyle, and you want to repeat that every year the rest of your life. You got to know what that is, and you got to be able to have that well integrated. So let's get into the meat of the topic here. As I said, I'm going to talk for about 20 minutes and then unlimited Q&A. Throw your questions in the chat or the Q&A if you like. At the end of this talk, I'm going to put a link up in the chat where you can schedule a free session with me to talk about your RSUs or any other financial topic just because you attended here today. That's a $300 value, $300 per coaching session is what I normally charge. I'm not going to charge you for this one because you attended. Okay, today we're going to talk about what is an RSU, what should we do now, and we're going to provide a tax smart way to make a transition should that be the direction we want to go. First off, it's important to understand what an RSU is and how it behaves and how it's taxed. So an RSU is basically just a share of stock in your company. It's awarded on some certain date, and then it vests sometime later. Now, when it vests, you're fully taxed on the value at that point. And after vesting, you're free to sell it or continue to hold it. Now, if you change jobs, you're likely to lose your unvested shares, but your vested shares will stay with you. So great. So when should we actually sell? Well, you should sell when the stock is high. Of course, that's always the answer. Very simple. The difficult thing is we never know when it's high, right? If we knew when it was high, we would have sold some time ago when it was high, but we didn't think it was high. But that really is the answer. So my statement here is there's no magic to this. We can't predict where our stock's going to go. We can't predict where any individual stock's going to go, any group of stocks, or even the market as a whole. Even all those financial professionals out there can't do it. None of them predicted the fall in COVID. None of them predicted the fall this year. You just can't do it. So what do? Well, here's what most people do. Most people say, well, the stock is falling, so I don't want to sell. I want to wait till it gets back up. And then when the stock's going up, they say, well, I don't want to sell now because the stock's going up. Why would I sell? Well, if you're not going to sell when it's going down and you're not going to sell when it's going up, guess what? You're never going to sell. That's no strategy. No strategy at all. Let's talk about maybe a better approach. So first, so we're going to ask ourselves a series of questions. First question, when will you use the funds? Now, that might sound like an odd question because I'm asking you, you've got this money in company stock, and I'm asking you when you're going to spend it. Well, maybe that's not entirely obvious. Maybe it's a long time from now. Maybe it's a short time. Maybe you're saving up for a down payment on a house, or maybe you have some repairs to do in your house. But if we have money that we're going to spend in the next 5 years, we don't want that money in the markets, and we certainly don't want it in any individual company stock. So if it's money we're going to spend in the next 5 years, we want to get it out of the stock. Okay, so let's say that's not the case. Let's say it's beyond 5 years. Okay, let's go to the next question. What does the rest of your portfolio look like? Is company stock more than 10% of your overall portfolio? There's nothing magic about 10%. It's kind of a number I pulled out of the air, but I think it's a good starting point. If your company stock is a large portion of your overall portfolio, you should really think about trimming that down, because that's a lot of risk in a single company. We know single stocks can go way up and way down. They can drop 70%, they can go up 70%, they can even go to zero. But if we had a group of companies, like let's say we owned an index fund that has 500 or 1,000 or 10,000 companies in it, what's the likelihood that all 10,000 companies go to zero at the same time? Not going to happen. Not going to happen without something really big going on in the world. So that's the beauty of diversification. So if we have more than 10%, and again, I'm going to talk a little bit more about this on the next few slides, but more than some percentage, consider trimming your exposure. Okay, let's say you've got a low percentage. So now it's money you're not going to need for 5 years, and you've got a low percentage in your company stock. Well, even then, consider selling, because diversification is the key to long-term success. Being rightly diversified, keeping your costs low, staying invested for the long term will lead you to success. So when should you sell? Pretty much all the time. And I'm going to give you a couple more reasons for that here in a moment, but let's go back to that 10% figure. So here's somebody, this might reflect you, might not, but you might think about your situation. So here's somebody who's looking at their total assets, and you can see their house is about 40% of their total assets. Their 401k is about 30%. They've got savings of about 10% and company stock at 20%. So let me ask you this. How do you feel this person has about their allocation of 20% in company stock? Is that good, bad? I said 10%, but remember I said, it's not a hard and fast rule. Is 20% too high or too low? Think about that. And then let me add this to the mix. We're talking about money that we need to spend, or that we're going to spend at some point in the future. We're not really going to spend our house, right? So including this 40% probably doesn't make sense. This is total assets, and so that's why we included the house, but it's probably not the right measure. Let's look at financial assets. Just take the house out. Now, same person, same dollars, percentages change, of course, because the pie got a little smaller, and so the pie slices get a little bit bigger, all of them. So now our 401k is 50%, our savings is 17%, and our company stock is 33%. How about that number? Is 33% too high? Well, I'm not done taking stuff out. You know why? You're not going to spend your 401k anytime soon. You can't spend it till retirement. You really don't want to. The penalties are too much. So we got to take that sucker out. And look where we're left now. Savings 33%, company stock 67%. These are your liquid assets, the available money to support your lifestyle. How about this? Is 67% too high? I think it probably is. So it's important to look at this decision in the context of your overall specific situation. That's what I want you to do, and that's what I want you to think about. Now, let's go on. How about taxes? Well, RSUs, remember I said RSUs are awarded on one day and they vest on another day. Usually, maybe they vest over 3 or 4 years. Well, when you get to the vesting date and you actually receive the stock, guess what? The IRS looks at that and says, you just got a paycheck, right? You just got compensation. It wasn't in the form of dollars, it was in the form of stock, but we know the value of that stock. And so we're going to tax you on it. And that's what the IRS does. So your custodian, where the funds are held, E-Trade or wherever, they will sell some of the stock automatically when it vests, and they'll send it off to the IRS. They don't sell enough. So if you're getting RSUs, it's likely you're going to owe tax at the end of the year because they're not selling enough to cover your tax. They sell 22%. My guess is you're in a higher tax bracket than 22%. So that's why you end up owing money at the end of the year. But let's go back to this concept. RSUs vest, you get taxed, right? It's just like a paycheck. Now, let me ask you this. If instead of giving you stock, if the company wrote you a check for that dollar amount, what's the likelihood that you would take that money and turn around and buy stock in your company? I'm guessing you wouldn't. Most people don't take a whole paycheck and go buy stock in their company, but that's exactly what you're doing by not selling it. By holding on to it, it's the exact same thing as if the company paid you cash and you went and bought it, because the IRS is going to tax you fully on the vest date of the RSU. So think about that. Think about whether or not you want to be taking a whole paycheck and buying stock in your company, or maybe start selling RSUs as they vest. Now, I know when stock was going up and up and up, it was great to hold on to the RSUs and sell it. But here's the problem. We don't know that it's going up and up and up. And of course, that's been proven to us by the last few months. So let's take that money out of that concentrated single stock position, put it into our long-term portfolio, which, by the way, we're going to talk about long-term portfolio construction next month in our next webinar. But let's do it. Let's do that with our stock that's continuing to invest. As it vests, sell it. There's no tax effect, no tax difference by selling it and putting it in your long-term portfolio. Okay, that's great for future vesting. What about past vesting? I've not been selling my RSUs. I've allowed them to build up. Well, let's talk about that for a second. Number one, make a plan. It almost doesn't matter what the plan is. As long as the plan allows you to reduce your holdings and get that money out of the concentrated position, make a plan and stick with it, or make a plan and adjust it based on learning about, exactly what you need. Now, what are the inputs to that plan? Well, your need for cash. If you actually need the cash, of course, you need to sell that sooner. You don't want the risk in your company stock. Your concentration in the stock, we've talked about that. You don't want high concentration in the stock. The diversification of the rest of your portfolio. Is the rest of your portfolio diversified, or is it in old employer company stock? Or is it in other stocks that you've picked up over time that sounded like a good idea, but you hadn't really thought about in a while? We want to diversify the whole portfolio. And then the last thing is the tax situation of each vested lot. Now, what the heck do I mean by that? Here's what I mean. Remember I said as it vests, the IRS taxes you? Well, you get one award, it vests over 4 years. That's 4 different tax dates. And so it may vest when the stock price is at 100, and then it may vest again the following year at 150, the following year at 200, and the following year at 125. Those are totally different tax liabilities depending on where the stock is today. You have to look at each individual one. If you're going to rank order and just sell a portion, you got to look at each individual one and know the tax effect of each one. This is especially true, or really it's only true, if you're going to sell in multiple tax years. If you've got stock that you've held on to in the past, and you're gonna sell it within a single tax year, like between now and the end of the year, you don't have to worry about that. Just sell it down over time, or sell it all at once, whatever makes you feel good, and get it out and go forward. Because the IRS looks at tax years, of course, from January 1st to December 31st. But if you're going to sell it over multiple tax years, let's say you've got a lot of the stock, like $2 million or $1 million, something like that, and you want to sell it over the course of, say, 3 years, then we got to look at the tax situation of each vested portion, because we want to sell the lot that has the most value and the least tax costs. So, for example, Stock price today might be 125. Well, if you have a piece of stock that vested at 125 when it was 125 some time ago, you can sell that and pay zero tax because you've already been taxed on the 125 where it vested. It's worth 125 today. Just get it out, no tax effect, over into your long-term portfolio. You may also have two other blocks where you have a gain and another one where you have a loss. You can offset those. So see, the goal is to reduce the overall exposure to the stock by and also limit the amount of tax that we have to pay in the first tax year. Now, if we're doing this over 3 years, you can calculate the total tax liability across all of it. And let's say the total tax liability on your $1 million is 100,000. Well, then you want to take 33,000 of tax liability each year. You don't want to sell an equal amount each year. You're going to sell more up front, but you want to have an even amount of tax liability each year. That's going to get you your lowest tax dollars paid over the 3 years. Now you have to consider, are your bonuses going up? Are you getting a promotion? Do you have other income coming in future years? I can help you with that. You can do that on your own, but you want to level out your tax over time. So that's my story. That's my presentation. I got done a little bit early. Here's what I want you to do. Now, what about you? Here's what's going to happen. You're going to get an email tomorrow. It's going to have a link in it where you can download these slides. You can watch the replay if you want. When you download these slides, I want you to think about your situation. What's right for you? Are you looking at this and thinking you might need to do something? If you're considering that, schedule a call with me. I'll do this. I'm offering this free consultation on this topic or really any other topic, but this is the topic we're talking about today. I'm going to put the link in the notes here. I have to be quiet while I type because that's just the way it works. So there's the link. You can use that link to schedule time with me. That link will also be in the email that goes out tomorrow. I promise you that there's definitely going to be no cost. I'm not going to charge you. And I promise you no sales pitch either. I just want to help you think through this situation about selling your RSUs. Very important to be diversified for your future financial life. Okay, other resources I have out there. I've got a podcast called Deliberate Money Moves. Check that out. I have a blog on my website, bestfinlife.com. It's called Best Fin Life because I was too cheap to pay for Best Financial Life. So Fin it is. And you can always email me, joe@bestfinlife.com. Happy to have some email back and forth if you have something going on. Next month, October 6th, we're going to talk about achieving long-term success from your portfolio. So we've talked about selling ESPP. We did that last month. We talked about selling RSUs this month. Now we're going to talk about in October, well, what do you do with the proceeds? Where does it go? How do I get a portfolio that's right for me? That's what we're going to talk about in achieving long-term success from your portfolio. One thing, note of disclaimer before I go to the questions. Don't see any questions yet, so if you got them, throw them in there. This is not financial advice. Financial advice is specific to you and your situation because everybody's different. Don't follow rules of thumb, especially those you see in the major media. Those are for the average person. None of you are average. None of you are anywhere close to average. I can only give financial advice to my clients. So that's not what this is. What we're talking about today is just simple general money moves that may or may not be appropriate for you. There's a few webinars here listed at the bottom. These are the topics that I've done in the past. Happy to share those as well if you're interested, but don't forget to schedule your free coaching session. All right. So that's my story. Please share your questions or comments in the chat or the Q&A, and I will get to them. I do see a couple of things here, maybe just one. Let's see. Let's go to the question. What about wash sale with RSUs if you are selling at a loss? Yes, wash sales can complicate the accounting. A wash sale basically says that if you sell a stock at a gain and then you buy it back within 30 days, the IRS will disallow the, I mean, you sell it at a loss and you buy it back, the IRS will disallow the loss. They don't actually disallow it. They just carry it forward. Now, think about this concept where I'm saying we're selling the RSUs as they vest, and we're selling our old RSUs. Eventually, very quickly, those wash sales are going to wash each other out, and you're going to get the full benefit of the taxation, of the tax advantage of capital gains and capital losses. So I don't really worry about wash sales because we're headed towards a place where we don't own any stock. And of course, by definition, at that point, we will have washed out the wash sales. And when I say don't own any stock, you're still going to have all your unvested stock, of course. So you've got exposure. You've got plenty of exposure. And so if the stock goes up, you're going to have plenty of money. But we're not gonna get to such a high percentage of our company stock. So hopefully that answers your question. Okay. So here's a response. Okay, so long as I sell RSUs as they vest and sell prior RSUs at a loss, we should be okay. Yep, it'll all wash out. Exactly. Okay, here's another question. If the stock vested 125 and I decide to sell it at 135, am I liable for that $10 gain? Absolutely. IRS wants theirs. So the stock vested 125, the IRS taxes you 125. Then you sell it at 135, the IRS wants their part of that extra $10. So that's going to be a capital gain, either short-term or long-term. There's no way to avoid that. Here's the deal. A lot of people will say, well, I want to hold on to my RSUs or my ESPP or my stock that I got from exercising options. I want to hold on and wait for long-term capital gains. I have to wait a year, sometimes a year and a half, but I want to wait to get a lower tax rate. That's great. The lower tax rate you're going to get is 15%. It's going to be about 15% lower, depending on where you are. Maybe it's 18%, maybe it's 13%, somewhere in there. But you have to hold the stock for a full year to get that. Now, what's the probability that the stock itself drops by 15% during that year? Because if it drops by 15%, you would have been better off just selling anyways. So much better. Again, all roads lead to reduce your company stock and reinvest. All right. Hopefully I answered that question. If not, feel free to put in a follow-up. Let's see. I don't see any other questions, so I'm just going to hang out for a minute or two, see if people are typing, and happy to stay on for a while and talk through this stuff. Let's see. Oh, I got to scroll. There we go. Oh, good. I'm glad I answered your question. I'm glad that was helpful. All right. Okay. Well, I don't see any other questions coming through. Thanks again for joining me this month. Next month, watch for that next webinar. That's very important because we want to reinvest our proceeds correctly. And that's what we're going to talk about in October. Until then, take care and enjoy yourself.